Hi, everyone, and welcome to this live stream, which is at a quite an unusual time for us. It's the market is actually closed, and it's late on for us on Friday evening. But there's a reason for doing this live stream at the moment because the mar the markets are at a very interesting point. And the topic for this live stream from myself and David is to look at anomalies because anomalies are one of the cornerstones of volume price analysis. And perhaps for those of you who are coming along the first time or haven't read the book or know a little bit about VPA but haven't gone into it uh, very closely, an anomaly is where there is a disconnect between what you're seeing in terms of price action and what the volume is telling you. And what we also want to do in this live stream is to look at anomalies across the time frames. I'm going to focus on the slower time frames, and David is going to look at some charts on the faster time frames because the principle is the same. The main difference, of course, is the question of time. And what's also important is that what we have to remember with anomalies and when we spot anomalies, and once you really get into VPA, you really do become an expert and they kind of jump out at you. The temptation is to jump in, is to think, oh, that's such a strong signal. I'm pretty certain I can anticipate what is going to happen next, and you jump in. And the key thing is you have to wait. You have to wait. It is a signal. That's all it is. It's a pay attention signal because sometimes anomalies take time. Clearly on the slower time frames, even more so by virtue of the fact that you are on a slower time frame chart. The best way to explain this concept is to actually see it on charts where we've got a few different instruments to look at today. We're not going to focus particularly on one market because these appear across all the capital markets, across all the instruments. And the key for you is to be able to spot them. And then once you spot them, is to then wait and wait to see how they play out. And of course, with anomalies, often they happen at times when you can get trapped on the wrong side if you jump in too soon or you perhaps misinterpret this very important relationship between the price action and the volume. So I'm going to go ahead and I'm going to share my screen. And what I'm going to be looking at is the MNQ, which is the E-mini for the NASDAQ. The NASDAQ, obviously, NASDAQ 100, predominantly dominated by tech stocks. And it's got to the point now where I did a calculation and the top one, two, three, four, five stocks make up 52% of the index. So we have a huge concentration of just a few stocks which drive the index. And the top five stocks are Nvidia, Microsoft, Apple, Amazon, and Meta. And if those five stocks are not performing, then the index will be struggling. But that is a topic for another day. As I said, what I really want to have a look at is the slower time frame charts because the markets they're tired. I mean, it's August anyway, and we do expect volume to reduce in the summer. Liquidity goes down. People go on holidays. Certainly we do here over in Europe. So there are fewer participants, but the markets generally have got this feeling that they're hitting all-time highs, but they do feel tired. And we always say, David and I always say, that when markets are hitting all-time highs and they're moving in this sort of quite a sluggish way, the predominant emotion from traders and investors is actually one of fear. It's the fear that at some point you're going to see a dramatic reversal. And goodness, every time you see a pullback and a correction, that's it. It's the bear market, and all the reasons come out why. This is the one. I've read that the market is in a similar state that it was in 1987 and Black Monday. I've also read that, my goodness, this is very close to the really big reversal that we had in 2000. Now, that may well be the case. And if you are going to see a reversal, we are going to see it first on the slower time frame charts, and we're going to see it through these anomalies. But as I said at the start, we really do have to be patient. And talking about emotions at the top, I said is fear. When we've had a correction and the market has crashed and it's falling and falling and falling, the overriding emotion is one of hope. We hope that the market will stop falling. We hope that it will find a bottom, and then we can all breathe a sigh of relief and the market reverses once again. So that's just our observation. So here we have is the MNQ. And I'm going to look at two charts. I'm going to look at the weekly chart, and I'm also going to look at the monthly chart. But let me just first start with the monthly for an even longer term view. And this was something that I've been meaning to highlight for a while. If I just pull that over and you can see what I mean now. You don't really need me to tell you what we are looking at here. We can see the market, this big market reversal that we had here back in April. We had this very, very deep hammer candle with a lot of volume. It actually bounced off one of my key levels. For those of you perhaps who haven't been to one of these sessions before, these are levels that I have put in manually, and I use them simply as sort of staging posts and to give some structure to the chart. But that was when the point where we saw this market reverse. They had pulled back over the previous 2 months, and at that point, everyone was convinced this was it. This was the one. And in fact, that candle, that was the close of the candle. But when that was formed, the market fell even more, and it was only towards the literally the last days of the month when the price was driven higher once again, and the bear, we all avoided that big bear market, and it was simply another correction. And it was a dramatic example of buy the dip, if you like. What's been happening since? And remember, April, May, June, they are busy months, if you like, from a liquidity and participation level. So we see the market rising, and what do we see? We see the spreads of the candles. There's that one, and it's narrowing. And we also see the volume either falling or we had last month and the month before, we have flat volume. So that is a huge signal telling us that that something is going to happen. We can't say when, but we have to be on alert. So that is a very dramatic example of the kind of anomaly that we should be looking at. Now, when I went down to the weekly chart for this week, I found it quite interesting, actually, because part of VPA is also looking at patterns, and we haven't dealt with a lot of patterns in these sessions, and it's maybe something we will certainly look at later. What we say about patterns, there is a hierarchy to patterns, and I'm talking patterns such as double tops, double bottoms, triple tops, triple bottoms, flags, pennants, etc., etc. And by hierarchy, I mean some patterns have a higher probability of developing and being, well, developing. That's the best way. That's the way I can describe it. But ultimately, whether they succeed or not, or they fail, will still be tied to the volume that is around that pattern, the double bottom. Are you actually seeing enough volume coming in to be able to validate that pattern? That's the word I was looking for. And the reason I'm looking at this now is we have this up candle here and we have this candle at the end of this week. Now, this is really, really early. So please don't, this is just something that I'm interested in, and I'm going to see how this plays out, because this is an anomaly on its own. And what is going to happen next week? If this time next week we have a down candle, we're looking at an evening star, which is quite an important critical reversal pattern. But as I said, this is the danger. We see these patterns, and we are, as a species, we are a pattern recognition species. Patterns, they help us. They helped us to survive in our evolution. That they're kind of ingrained in us, but we mustn't be too quick to jump to a conclusion. But I just thought I'd mention it because I sometimes sort of use it as a test for myself to say, now hold on, I think this is what I'm seeing, but let's wait and see. And this is where we have to be patient, and patience is something as traders and investors we're not actually very good at. So that is the MNQ. I simply chose it. It's an instrument that David and I trade ourselves. It's also the instrument that we use a lot for teaching our students, because we find it's very deeply liquid. It's a 24-hour market. We have students from all over the world. So it's important to be able to access an instrument that will give us the opportunity to be able to talk through the price action at the live edge of the market. And those of you who may know already, we've been coaching and mentoring now for a little while. And one of the things that we have found quite surprising, that we've been told by some of our students, is that as far as they're aware, where some of the coaching and mentoring that we do is purely at the live edge. We look at historic charts, we look at examples, but when we're actually on a 1-to-1, or in our case, a 2-to-1, because there's two of us and one of them, we only ever look at the live edge of the market, talk it through with them, and then teach them, and then they have to repeat it back to us, which some of them find very, 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 very nerve-wracking. But once you understand what you're looking at and you've studied the material that comes with the coaching and mentoring, it really does make an awful lot of sense. Turning to the market sentiment at the moment, what you also need to be aware of is the volatility. We've mentioned volatility before. The markets are they're not volatile. In other words, they are complacent. We look at the VIX, and what I have here is called the VVIX, which is the VIX of the VIX, and it's an index which gives us an insight as to whether the market is in fact complacent or not. And you have these levels, and you can see it's really sort of in a sideways at the moment. What I have here is the 200 MA. And the 200 MA is I always call it a psychological level, because it's, even mainstream financial media write about it. And at the moment, on the weekly chart, it is actually still below this. So in a way, what is that telling you? Well, it is telling you that it is pressuring the 200, but it needs to go through that if the market is to reverse. And obviously it'll spike much, much higher if you have some major trigger for the markets to reverse. Or there isn't. What could that trigger be? Well, we had the PPI earlier on for the US, and there was a knee-jerk reaction on Thursday morning. Markets fell. The stock market fell pretty heavily, but it recovered. So doesn't seem to be too concerned about inflation, certainly doesn't seem to be too concerned about tariffs, certainly doesn't seem to be too concerned about geopolitical events. There's obviously the summit that's going on at the moment in Alaska, but often the trigger will come from left field. It's something that is out there. It's just at the moment it is a known unknown, in the words of Donald Rumsfeld. But what's interesting is that it is contained between the 200, and that will put pressure to the downside. If it goes down to the downside, then the markets will remain elevated. They will maybe continue to creep higher. More worry will come into the market. Paradoxically, they will become more complacent. So it's just this, we have this combination of factors at the moment, which from an investing perspective makes life very, very difficult. From a trading perspective, could make life difficult if you jump too quickly onto a signal such given by an anomaly too quickly. So that's really all I wanted to say on anomalies and on the slower time frame charts, because this is only a very short live stream, because the markets are in this very, very interesting state at the moment. They're looking a little bit fragile. What's coming on? What's coming ahead? I think we've got what's the PCE, the more inflation data. More importantly, from a Fed perspective, we have what's called the Jackson Hole Symposium, not next week, the week after, and really the markets really get into gear once once Labor Day's over, which I think this year is at the beginning of September. And then the talk between now and then will be whether the Fed cuts again in September. There's a whole narrative surrounding the Fed and what they'll be doing with the reverse repo and their QT and et cetera, et cetera. Everything I talk about, that David talks about, is actually contained in our education programs, because it's not just about becoming proficient in VPA. It's understanding the other drivers of the market and how they contribute towards framing the narrative. Fundamentally, it is chart, it is understanding and becoming a real VPA master, understanding the significance of anomalies, understanding how to spot them, understanding how you have to be patient before you make a trading decision. But we felt that when we put the program together, it was really important to put in as much as possible, and certainly what we felt was important for traders, and it's both traders and investors, because the only difference between a trader and an investor is the amount of time that you spend in the market. And we all start as traders, but eventually we do all become investors in some shape or form, whether it's for short term, medium term, or longer term. The underlying methodology, the underlying principles apply to whatever time frame you decide to trade, right? For those of you who were here last time, and we looked at the pound Aussie, and again, it was looking at VPA and the significance of significant levels at inflection points on the chart. And we were looking at certainly if you're a Forex trader, if you wanted to trade the slower time frames, certainly for a cross pair, that is what you would be. Really, for a cross pair, is probably the slower time frames you would have to trade because of the spread. And if you are going to go into the slower time frames, here you have to have a little bit more of an understanding of the fundamentals and the monetary policies for the individual central banks. And here we have the BOE and the RBA. And when we had the session, the price action was around about here at 2, this exchange rate here. And what I said was it will be really determined by what the two central banks were going to do. We were speaking ahead of the interest rate decision for the Bank of England. And then the following week, there was the RBA. The Bank of England did cut, but said they were concerned about whether cutting further because we have an inflation problem here in the UK. We have a stagflation problem, but that was it. But when the RBA, they also cut, and they completely reversed their position from earlier on in the year, where they were a little bit more hawkish. They said, oh yeah, there were probably more interest rates cut coming. And what does that do? Ultimately, from a fundamental perspective, it is interest rates which drives the value of a currency. The higher the interest rate, usually that will strengthen the currency, which is why we saw this kind of break higher away from this, as I said, this inflection point, and we've had a really nice move. What's interesting is the volume. So whilst that has, from a price action perspective and from a purely a technical chart perspective, yep, that's done what it's supposed to have done. But what I don't like is I don't like to see this. So maybe it's not going to go very far. But it's kind of played out how we said it would likely play out, dependent on what the two banks were going to say. Right. As always, if you've got any questions about anomalies or anything VPA related, I'll just put them in the chat box, or you can drop me an email at anna@annacooling.com.